Hi, I'm Jeff Colton, and this week we'll be going to show you the key components of both the balance sheet and income statement. This is important for you since the income statement is one of the main financial statements that you will use to determine how well an organization has been performing. The balance sheet shows what resources an organization owns and owes. If you want to invest, you must understand how to read these statements. We look at the other main statement, the cash flow statement, next week. One key insight we want you to take away is that the three statements all relate to each other. We'll show you how. We'll look at one rule of the accounting language. That's the balance sheet equation. We'll see how the balance sheet equation makes all the financial statements fit together. The balance sheet equation is one of the keys to understanding financial accounting. It says that assets equals liabilities plus owner's equity at all points in time. Another way to say this is that the resources of the company equal the claims on those resources by outsiders and by the owners. Let me show you how this works in real life. Suppose we want to buy something big, like a house or a car. Let's say we wanted to buy a $1 million house, but we only had $100,000 of cash. So we'd need to go out and borrow $900,000 from the bank in a mortgage in order to buy the house. Then after we bought it, we'd have $1 million in assets, the house, which is equal to the $900,000 worth of liabilities, and we'd have $100,000 in equity, which is how much cash we put in and represents our claim on the house. The most important feature of the balance sheet equation is that it must always balance. This means that each time we record a transaction in the accounting system, the accounting equation must remain balanced. This is what is behind what you might see described as double entry bookkeeping. And as we'll see, the changes between two balance sheets are going to be summarized in the income statement and the cash flow statement. The balance sheet provides a snapshot of the resources that an organization has at a point in time, its obligations, and the way in which the organization has funded those resources, be it through debt or through shareholders' equity. The resources are known as the assets of the organization. The assets include things like cash, inventory, property, and equipment. Liabilities include the obligations of an organization resulting from past transactions, and equity is the residual interest in the assets of the organization after deducting its liabilities. The profit and loss statement, or income statement, shows the financial performance of the organization over a period of time, such as a half year or a full financial year. The income statement shows the revenues of the organization for the financial period and deducts from those revenues the matching expenses. The income statement and the balance sheet are linked through the shareholders' equity part of the balance sheet. One of the accounts in shareholders' equity section of the balance sheet is the retained earnings account. This account shows the profits that have been generated by an organization over time that have not been paid out as dividends. In other words, the profits that have been retained by the firm. So the net profit earned in a year makes the retained earnings account go up, while paying a dividend makes retained earnings go down. Let's look at the components of the balance sheet in more detail. First, assets. An asset's a resource that is expected to provide future economic benefits. That means it's either going to generate future cash inflows or it's going to reduce future cash outflows. There are two criteria that we use to decide when to recognize an asset. First, it must be acquired in a past transaction or exchange, and secondly, the value of its future benefits can be measured with a reasonable degree of precision. So for example, if we buy a truck, the truck would be considered an asset. We acquired ownership of the truck in an exchange, and the value and the benefits of the truck are equal to the price that we have paid to buy the truck. So both criteria are satisfied, and it would be an asset on the balance sheet. Let's assume that your firm is advised by a marketing firm that its brand name is worth $40 million. This would not be an asset because we never acquired it in a past transaction or exchange, and you can argue that the value of the brand cannot be measured with a reasonable degree of precision. So it doesn't really meet either criteria for recognition. This is simply a case where accountants have decided to err on the side of reliability or objectivity. Without a market transaction where the company has acquired the brand, we can't be sure of how much it's worth. And so we err on the side of leaving it off the financial statements. For this reason, you often see the value of the company in the share market, that is, its market capitalization or market cap, can be greater than the value on the financial statements, so the book value of equity. Because investors would consider the brand name to be an economic asset, whereas the accounting system is going to ignore this asset as not reliable enough. Now, we're going to turn to liabilities. A liability is a claim on assets or creditors or non-owners that represents an obligation to make future payment of cash, goods, or services. Just like an asset, there are two criteria for when we recognize a liability. First, the obligation is based on benefits or services received currently or in the past, and second, the amount or the timing of the payment is reasonably certain. And even though the words are different, these are essentially the same two criteria for the assets. The first one says there has to be some kind of transaction or exchange where you would have received something that creates an obligation. And the second criteria says that you can measure the amount of what the obligation is. So, for an example, let's say we borrow money from a bank. We have an obligation to repay the bank based on receiving the benefits of getting the money now. The amount and the timing of the payment is reasonably certain. And if there was any question, I'm sure the bank could clarify how much exactly we owe them. So borrowing money from a bank would meet both criteria. And it would be a liability called something like loan payable or mortgage payable. Finally, we have shareholders' equity. Shareholders' equity is the residual claim on the assets after settling the claims of the creditors. In other words, it's assets minus liabilities. There are a lot of synonyms for this. It's also called stockholders' equity, owner's equity, net worth, net assets, and net book value. Unlike assets or liabilities, there are no criteria how to measure stockholders' equity. Because if you measure all of your assets correctly, and if you measure all of your liabilities correctly, then shareholders' equity is whatever is left over. Remember, assets equals liability plus shareholders' equity. But there are two main sources of equity. The first source is what we call contributed capital, which arises from selling shares to the public. The other source of shareholders' equity is retained earnings, which arise from operating the business. Retained earnings is the accumulation of accounting income, which is revenues minus expenses, less any dividends that have been paid out since the start of the business. So what are dividends? Dividends are distribution of earnings to shareholders. So your retained earnings at the end of the year is going to be retained earnings at the start of the year, plus your net profit or loss, less any dividends paid. So your income statement and your balance sheet are linked via the retained earnings account, which is part of shareholders' equity. We'll see in the next two units how these two statements are linked to the cash flow statement. The income statement, or statement of financial performance, tells a story about the organization's performance over a period of time. Sometimes it's a financial year or a half year or a quarter year for firms doing quarterly reporting. The income statement uses accrual accounting and sets out the revenues and expenses, where net profit for the period is equal to revenues less expenses. You can think of revenues as increases in the organization's wealth arising from the provision of services or the sale of goods to customers. Wealth increases because customers pay cash for the services or goods, or promise to pay cash in the future, or pay with other forms of wealth such as assets. I guess Bitcoin is a current example. The key test for whether revenue can be recognized in the income statement is whether the goods or services have been rendered. That is, delivered or provided to the customer. This can become tricky for complicated transactions. Expenses are decreases in the organization's wealth that are incurred in order to earn revenue. Expenses can include amounts paid to employees as well as for rent. For some businesses, cost of goods sold is a major expense. This account summarizes how much it costs the business to make the goods or services that are provided. Not all expenses involve cash leaving the business. Under accrual accounting, organizations often allocate the cost of non-current assets such as equipment over the period they expect to use those assets. The allocation of the cost of non-current assets to particular financial periods is called depreciation. Net profit is the difference between revenues and expenses in a period, and it represents the net inflow of wealth to the organisation. Note that it is not the same as the amount of cash received by the business. That's a separate matter. We'll talk in more detail about how cash flow is different from revenues and expenses in the next unit.